Welcome to Iron Financial. Our mission is simple. We help you forge a stronger portfolio. How? By putting companies on the anvil and seeing what they're really made of. Today, we've got Better Home and Finance, ticker BETR, in our sights. They just dropped their Q4 2025 earnings, and man, the headlines are glowing. But here at Iron Financial, we don't just read the headlines. We take a hammer to them. We heat them up, we bend them, and we find out if they're solid steel underneath or if they're just going to shatter under pressure. All right, let's get to it. Here's our game plan, our protocol for today's stress test. First, we're going to tear into that headline hype. You know, the big, flashy numbers that got everybody talking. Next, we're getting our hands dirty. We're going to inspect the core of their whole operation, something they call the Tinman AI engine. Then we start applying pressure. We're looking for cracks in the foundation, and that means a hard look at their profitability, or, well, lack thereof. After that, we'll lay out their own blueprint for forging a path to profit. And finally, you know what's coming? We deliver the unvarnished, no-nonsense Iron Financial verdict. So, when you strip everything else away, it all boils down to this one single question. Is BTR building a genuine fintech fortress? A new kind of company that's set to absolutely dominate the old, clunky mortgage industry? Or is all this crazy growth just a flashy, fragile house of cards, one that's about to come crashing down under its own weight? The market's buzzing, the hype is real, but we're here to cut right through that noise and find out if this structure is actually built to last. Okay, let's start at the beginning. Let's look at the stuff that got everyone's attention in the first place, the top-line numbers. These are the big billboard figures that drive the story on Wall Street. And you got to admit, on the surface, they are nothing short of spectacular. Let's break them down. I mean, just look at that number, 77%. Let that sink in for a second. That's year-over-year revenue growth. In any market, that's not just growth, that's an explosion. We're talking about a jump from $25 million in Q4 of 2024 all the way up to $44 million in Q4 of 2025. That's the kind of number that makes you sit up and pay attention. You can think of it as a main pillar of their bull case. It's a powerful signal that they are grabbing market share at a breakneck pace. This isn't some small incremental gain. It's a massive expansion. And this right here, this proves that the revenue growth isn't just some accounting gimmick or paper gain. It is absolutely backed by real-world heavy lifting activity. Look at that. Funded loan volume shot up 56%. They went from funding $936 million in loans to a jaw-dropping $1.5 billion. That shows they are moving serious product. It's not just that they're making more money per loan, they are funding a heck of a lot more loans, period. This is the muscle that supports that 77% revenue number we just saw. Well, whoa, hold on a second, pump the brakes. Numbers like this look fantastic on a slide, I get it. But my job here is to represent everyone watching who's thinking, is this real? Is this actual sustainable growth? Or is it just some expensive scaffolding they put up to make the building look good? You know, are they just buying revenue? Anyone can post huge growth numbers if they're willing to light enough cash on fire to do it. So I gotta ask, what is the engine here? What's really driving this? And is it a durable long-term advantage? Or is this just a sugar high? And that is exactly the right question to ask. That's the billion-dollar question. And the company's entire answer, their whole bull case, it really hinges on their core technology. The whole story they're telling the market rests on their AI platform. They call it Tinman. And according to them, this isn't just some add-on feature. They claim it is the entire foundation of their business model. So here it is, Tinman. The company pitches this as the central load-bearing wall of the entire operation. So what is it? The big claim is that by automating the entire mortgage process, from the first application to the final funding, they can operate with a fundamental structural cost advantage that their old-school competitors just can't match. In fact, their investor deck claims mortgages originated using their tech cost 43% less than the industry average. Now, if that's true, if they can actually prove that out over the long term, that is a tectonic shift in the economics of this entire industry. That's a game changer. And here's where it gets really crucial. They're not just keeping this secret sauce for themselves. They're licensing it out. They are turning Tinman into a business-to-business, a B2B platform. This is how they're reinforcing that foundation, building it out with steel beams. They've launched with a massive player, Credit Karma, and pre-approvals are scaling like crazy. They went from just 850 in October to 13,000 by February. They're live with Finance of America, they've expanded their partnership with Neo, and get this, they claim it's boosting loan officer productivity by an incredible 91%. This isn't just a theory on a whiteboard. They are deploying this tech with major industry players right now. And if you still think this Tinman platform is just some side project, some marketing fluff, well, look at the proof right here in the numbers on this chart. The Tinman AI Platform, their B2B channel, already accounts for $646 million in loan volume. That's 44% of their entire funded volume for the quarter. Let me say that again, 44%. This is not a future ambition. This is a core, critical part of their business today, and it is growing fast, up 34% just from the last quarter. And of course, the CEO himself, Vishal Garg, is out there doubling down on this story. He's on record saying they're seeing a wave of inbound interest. Now, what's a quote like this for? It's meant to signal to the market that the big partnerships we just saw, that's not the end of the story. They believe it's just the beginning. The whole strategy is to become the technological backbone for other lenders. And that's a much more scalable and potentially much higher margin business model than just being another direct-to-consumer lender. Okay, fine. I'll give you that. The AI story is compelling, the partnerships are real, I see the numbers. But you can't build a fortress out of tech demos and partnership announcements. A structure, a real business, needs a solid financial foundation. So let's stop admiring the fancy architecture and start stress testing the concrete. It's time to see the bottom line. What did all of this incredible, amazing growth cost them? Because as we say around here, revenue is vanity, profit is sanity, show me the money. And there it is. This slide just lays out the whole conflict, the whole bull versus bear debate in black and white. On one side of the ledger, you've got this beautiful, seductive growth story. 77% revenue growth. Wow. On the other side, you have the ugly, cold, hard truth of the balance sheet. A $40 million GAAP net loss in a single quarter. An adjusted EBITDA loss of $24 million. Look, these aren't minor leaks you can patch up with some putty. These are significant structural cracks in the foundation. Volume is great, but it does not pay the bills. Profit does. And right now, there is zero profit to be found. That's a totally fair point. The loss is a big number, and nobody's trying to hide that. But looking at that number in isolation misses the most important part, the trajectory. You have to see which way the ship is sailing. Yes, they are losing money, but look at the trend. Their GAAP net loss actually improved by 33% from this time last year. The adjusted EBITDA loss improved by 14%. You know what that shows? It shows operating leverage. It means as their volume and revenue scale up, the losses are getting smaller, not bigger. They aren't just spending more to get more, they are growing more efficiently. That's not a sign of collapse. It's a sign they're building towards a stronger, self-sustaining structure. Okay, improving losses is a nice way to put it, but they're still losing millions of dollars every month. I'm not convinced. I want to dig even deeper into where this growth is coming from. Let's get more granular. Where is this $1.5 billion in volume actually being generated? Is it from a stable, durable source like people buying new homes, or is it coming from a much more volatile, flaky segment of the market? Let's break down the product mix. Aha, and there it is. This is what worries me. Look at that number, a 207% explosion in refinance volume year over year. That one product line is the rocket fuel strapped to their growth. Yeah, purchase volume grew a perfectly respectable 22%, but the refi market is what's putting up these eye-popping headline numbers. And here's the problem. The refi market is notoriously cyclical. It is hypersensitive to interest rates. When rates go down, a tidal wave of homeowners rushes to refi. It's a boom. But the second rates tick back up, that wave recedes just as fast, and that entire river of revenue can dry up overnight. So the question becomes, is their growth really a product of superior tech, or are they just surfing a temporary refi wave? What happens when the wave is gone? You know what? The reliance on the refi market is a valid risk. It's a huge risk, and it's one we absolutely have to acknowledge. A business built on that is a house built on sand. But management isn't sticking their head in that sand. They know this is a problem, and they've laid out a very specific, very public plan to address the profitability issue and to fix these cracks. So let's look at their official blueprint, the guidance they've actually given to the market. This is their public promise of how they're going to forge a path to break even. Now, this timeline is ambitious, I'll give you that, but it is crystal clear. For Q1 of 2026, they're guiding for continued strong loan volume, basically keeping the pace from Q4. Then they're reaffirming a monthly run rate of $1 billion by the end of May. But the most critical, the most important date on this entire slide is that last one. They are putting their credibility on the line, reaffirming their target to hit adjusted EBITDA breakeven by the end of the third quarter of 2026. This isn't a vague hope. They are putting a date on profitability. And to add some serious weight to that commitment, we have this quote from their new Chief Financial Officer, Levine Advani. He's not just making a wild guess. He is explicitly tying their confidence to the trends they're already seeing: accelerating volume, revenue growth, and expanding margins. This is a forecast they claim is based on the operational leverage they're already starting to demonstrate. And to having a new CFO put his name on a target like this, well, that's a pretty powerful signal of intent. He's putting his reputation on the line. A blueprint is useless if you don't have any materials to build with. A timeline is completely meaningless if you run out of money before you get to the finish line. So this brings us to the final and maybe the most crucial question of all. Do they have the cash to survive this construction phase? What's in the war chest? The clock is ticking toward Q3 2026. Do they have enough fuel in the tank to get there?
That is the ultimate stress test. And here's the data. As of the end of the year, they had about $229 million in cash, restricted cash, and short-term investments. On top of that, they have access to $575 million in warehouse financing capacity, which is what they use to fund their loan originations. Now you look at their current burn rate, and this appears to be a reasonable cushion. It's not infinite, but it seems like enough runway to get them to that Q3 break-even target if they execute.
All right, so we've examined the hype, we've inspected the engine, we've taken a hammer to the foundation looking for cracks, and we've reviewed the blueprint. Now it's time to bring it all together. It's time to run that final stress test and deliver the iron financial verdict. When you put it all together, is this an opportunity to build wealth, or is this just a trap waiting to be sprung on unsuspecting investors? So here it is. Our stress test gives us 4 key takeaways. Number 1. The top-line strength is absolutely real. That 77% growth is powerful and you can't ignore it.
Number 2, the Tinman AI engine is legit. This is not just some marketing gimmick. It is driving almost half their business, and it's landing major industry partners. This is their core structural advantage, if they have one.
Number 3, the foundational weakness is profitability. There's no way around it. This is the single biggest risk factor. The company is burning cash, and its path to break even depends on flawless execution and a market that cooperates.
And number 4, the blueprint to fix this weakness is in place. Management has given a clear, date-stamped target for break even, and it looks like they have the cash on hand to at least make a run at it.
And so we end right where we started, with that one central question. Is this an opportunity to get in on the ground floor of a company that could fundamentally rebuild the entire mortgage industry with technology? Or is it a trap under construction, where an optimistic blueprint simply won't survive contact with the harsh reality of economics?
Right. The bull case sees a disruptive tech leader, a category killer that's right on the cusp of becoming profitable. The bear case sees a cash-burning machine that's way too dependent on a hot and very fickle refi market.
The answer ultimately depends on your personal tolerance for risk and your belief in management's ability to execute on that very ambitious plan. Here at Iron Financial, we don't give you the answers. We give you the tools, we give you the analysis so you can forge your own path. We lay out the strengths, we expose the weaknesses so that you can make a sound, strong decision for your own portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.